Hey Bowtie Nation, Joseph Hogue here with your Monday market update, 9 a.m. Eastern every Monday morning. Get you ready for the week with stocks to watch, market trends you need to see. And Nation, U.S. investors pulled $13 billion out of ESG funds last year, but not for the reason you might think. In fact, the largest of these funds returned 18% through the year, but couldn't stop investors from rushing to the exits, redeeming $9 billion from the ETF. I'll detail why that $13 trillion ESG universe is dying and a better way to invest. Stick around after that and we'll do our weekly market update with the stocks I'm watching this week and how to invest. First though, with the drop in interest rates from I-bonds and money market funds, I've had to look somewhere else to get a return on my cash. Now that's why I'm also investing in Worthy Bonds for a 7% yield, a fixed income platform with bonds backed by small business and short-term real estate loans. You can invest as little as $10 per bond and earn interest on a daily basis. Best of all, you can withdraw all or some of your money anytime with no fees or penalties. Worthy even has a roundup feature that lets you invest your spare change on purchases into bonds, automatically building your portfolio. You can even gift someone a bond with just their email address. I'll leave a link in the description to more information. Use the link and you're going to get an exclusive deal I worked out for everyone out there in the Bowtie Nation. Buy 5 bonds and get 1 free. Invest just $50 and get $10 free. That is a 20% return on top of that 7% interest rate. So look for the link below or just scan the QR code here. Back to that main topic though, because ETFs created around that environmental, social, and governance theme have been slammed with closures. Last year saw just 48 new funds, less than half the number created in the year before, while the number of funds closing more than doubled to 36 during the year. The selling has been most pronounced in the United States, with investors pulling $13 billion out of ESG funds last year, and $5 billion of that in the last 3 months alone. In fact, Japan and Canada also saw net selling, with investors withdrawing $1.4 billion from the funds, while those in Europe, Asia, and Australia invested $4 billion more. This all contrasts remarkably with 2021, when investors pushed more than $180 billion into these funds in the first quarter alone. U.S. investors anteed up more than $20 billion that quarter and invested nearly $60 billion throughout the year. Usually when an ETF theme sees this kind of massive closures, it's because the theme or the investment idea has seen equally massive losses. That isn't the case here though. The largest ESG ETF, the iShares ESG Aware USA ETF, that's the ticker ESGU, saw $9 billion withdrawal last year and is already down $809 million this year, even as the stock price has jumped 17.7% in 2023. You could argue politics has played a part, and that's part of the reason. ESG and other issues have become lightning rods before the presidential election this year, and it's never easy to grow a fund when half of the population is ideologically against your theme. You could also argue that investors have just given up on ESG funds because it's a confused mess of stocks that really doesn't fulfill the purpose. That largest fund, the iShares ESG Aware, is supposed to track U.S. companies that have positive environmental, social, and governance characteristics, but when you look at the top list of the holdings, it just looks like any other large cap index, and you realize the case for any of these as ESG is controversial at best. Apple may not be making the iRocket launcher anytime soon, but it's been repeatedly accused of using forced labor and abusing foreign labor. For its part, Amazon has a giant carbon footprint in its logistics and data center operations and has been slow to commit to sustainability goals. But the bigger reason these ESG funds just have not worked is because this kind of theme investing just doesn't make sense on an investing strategy. Now, before you click out thinking I'm a cold-hearted SOB that doesn't care about environmental or social issues, let me explain here. Investing in an ETF based on a theme is fine, but that theme or the grouping of stocks needs to be based on a reasonable idea that would produce either a return or diversification. Investing in the Vanguard Index, the VUG, makes sense because targeting those large cap stocks that grow their earnings should produce a return better than the overall market. Or investing in the VanEck Semiconductor ETF, the ticker SMH, spreads your risk across that hot semiconductor companies without the risk in any one stock. But then investing on moral grounds, while a noble intention, isn't something that should rationally produce either of these benefits. You could try to argue that companies protecting the environment or that care about social issues are good stewards of humanity, but it's a pretty tough argument to make that any of this would result in stronger profit growth or shareholder returns. Also, withholding your investment dollars from companies that violate ESG standards doesn't necessarily hurt those companies. Once a share is issued on the exchange, it trades between investors. When you buy that stock, that money goes to the previous investor holding the shares. The company doesn't see a dime of it. Nation, none of this means you shouldn't try to improve the world and do your part. Now, I am a cold-hearted SOB, but I still care about the world in which my kids grow up. But if you want to change the world, there are more effective ways to do it, like volunteering or supporting startups in that cause, or even using your right to protest. All of these can directly affect and change the world, and they also let your money continue to grow in other investments that have that sound rationale in returns. Opening it up to the stocks I'm watching this week, first up, Advance Auto Parts, ticker AAP, going to be reporting its earnings on Wednesday, with investors still waiting on that turnaround after the 75% stock slide since 2022 and last year's management shakeup. Competitor O'Reilly Auto, ticker ORLY, missed its sales expectations, but then beat on earnings when it reported earlier in the month and saw its shares fall 4.5% on the news. Shares of AAP are already down 10% from a rebound earlier this month and may have potentially bad news already priced in. I continue to hold the shares with a cost basis of around $58 per share on the idea that the company could become a takeover for private equity buyers. That main business can be cash flow positive, and management has already said it was going to open up to selling off some of their international assets that are going to strengthen the balance sheet. Also watching WW International, ticker WW, it's plunged 75% since October after surging 226% from the March low when the company said it would acquire Sequence Health and offer GLP-1 weight loss drugs as part of its system. Investors have lately worried that a direct-to-consumer offer of drugs by Eli Lilly is going to sap demand for Weight Watchers, and that membership has not turned around. While I don't think the shares are worth anything close to $13 they hit last year, there is still strong value in this brand, and app download tracking from SensorTrack suggests that membership growth is returning. There is enough demand for these GLP-1 drugs to go around, and I'm buying shares on the idea that management is going to be able to surprise on the upside for earnings and its outlook. A lot of AI software stocks are going to be reporting this week, with many of the group failing to see that uptick in prices enjoyed by the hardware chip stocks like Nvidia and ARM. Last year's frenzied stock buying may have been premature, but AI software leaders should be the next big beneficiaries after these chips are built. Unity Software, ticker U, is going to be reporting Monday after the close, and it's really a leader in that video and gaming software. C3.ai, ticker AI, and Schrödinger, ticker SDGR, both are going to be reporting on Wednesday, with all three stocks as yet to retake their highs reached in last year's run on those AI stocks. Now, valuation multiples are still high here, but I'm adding to these positions before earnings and would buy more on any pullback, building that position in these stocks that are going to lead in that next leg of artificial intelligence. More than 90% of the stocks in the S&P 500 index have released their earnings, with companies reporting 3.2% earnings, 4% revenue growth on a year-over-year basis. Now, that is well above the earnings decline expected by analysts before reporting, and has shown the economy can withstand those higher interest rates and keep growing. Analysts expect earnings for the first quarter to be reported in April through May. It's going to show 3.9% growth in earnings and 3.5% sales growth. And that is undeniably good news for stocks, but it could keep the market on edge if we don't see inflation continuing lower. Surprisingly high reports by the consumer prices in the CPI and producer prices in the PPI showed a bumpy path for inflation earlier this month and caused that first week of falling stock prices in 6-week run. We'll see the important personal consumption expenditures, that's the PCE report, on Thursday to either confirm that persistent inflation pressures or to calm the market down further. It's that preferred measure for use by the Fed and is critical in that idea that the Fed can start cutting its interest rates by June of this year. Another hot inflation report, and investors might have to push back those expectations even further, yet again taking some of the steam out of the stock market. Get your free bond and a 7% yield on your cash with Worthy Bonds and the link in the description. Or click on the video to the right for my complete 2024 investing strategy and the stocks I'm buying. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.